Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Balancing reliable income with long-term growth is one of the biggest challenges facing investors today. In this episode, we explore how a multi-asset approach can deliver both, even in volatile times.
I'm Chris Sarley, and today I'm glad to be joined by Paul Flood, who is manager of the BNY Mellon Multi-Asset Income Fund. Paul, once again, thank you very much for joining us.
Thank you very much for having us on, Chris.
No problem at all. Let's start with the structure of the fund itself. I mean, the approach is kind of two-pronged in that not only are you trying to deliver a consistency of capital growth, but also a consistency of income. Now, income, as we know, has kind of become even more and more important throughout the years for investors. But I don't think, despite what we've seen in recent years, that they quite understand sometimes the consistency of income can also be a challenge, and that's an important part of what you're trying to do. Maybe just explain to the listeners how you go about meeting that challenge.
Yeah, well, I think, income to us is probably the primary objective in the fund. And I think advisors, clients are starting to understand that, given the change that we saw with the FCA's Thematic review, really encouraging advisors to think differently about investment propositions in retirement, and to consider the loss of income is a priority for those people in retirement as much as what people think about the capacity for loss of capital. And when we set up the strategy, we thought long and hard about what clients in retirement would be looking for, particularly given we will have far fewer people going forwards that have a final salary pension scheme that really covered off a lot of their income requirements in retirement. And because of that, unlike those with final salary, those people with defined contribution or SIPs going forward will be relying a lot more on their advisors to generate their income needs from their retirement portfolio or their investment portfolios. And in order to do that, advisors need the confidence that the income is stable and consistent, so that they can rely upon it and help with their income planning for clients. And we believe the key priority is to deliver a stable and growing income, pence per share, pounds in pockets, that allows investors who, even if they are retired, to remain invested in growth assets, as they still have a very long investment horizon. And so our process will focus on securities that can pay and grow their income, allows or has allowed the strategy to hold up in two particularly challenging periods, particularly for income investors. Firstly, in 2020, during a pandemic period where many companies cut their dividends, we managed to deliver a stable dividend through that year. And that's because of our philosophy of trying to identify companies, securities that can pay and grow their dividends irrespective of the economic backdrop. And we had exposure, or a large exposure, to assets that had contractual cash flows that were availability-based revenue streams, and they were much less economically sensitive. And then secondly, we need to grow the income over the longer term as well, because people's disposable income requirements will go up with inflation. And so in 2022, when inflation peaked out at about 10.1% in the summer of that year, we actually grew our monthly income, or raised our monthly income by about 10.2% in line with inflation. And that's because we had allocations to those kind of real assets that had inflation-linked revenue streams, and therefore were able to grow their dividends to investors as well, allowing us to grow the dividend in real terms.
Okay. Do you look to target a specific number with it?
No, we don't. We've done a lot of work when we initiated the strategy, looking back at what we're trying to achieve and making sure it was an achievable outcome, but also it had longevity to it. So, we need that income to be attractive in periods of low interest rates and high interest rates. You don't want to overreach for income, because that'll end up paying out income at the expense of capital. And obviously your capital base is your income generating capability of the future. So you don't want to overreach for income. And so the way in which we try to set out an achievable income and one that will remain attractive throughout time is really to target a 30% premium to a traditional 60-40 portfolio. That's kind of your investable universe. So as bond yields rise or equity dividend goes up, obviously our target goes up, but it will be achievable because there will be assets in the investable universe that generate an income of those levels. But also it's not too hard an objective because in order to grow the dividend or to grow the income, you need to grow the capital over the longer term as well. So you want to make sure you don't reach too high for income that then puts the capital or undermines the capital to ensure that you can grow both the income but also the capital.
I mean, a lot of people talked about the sort of dearth of income post the global financial crisis, and a lot of managers started to look towards alternatives as another way, another income stream to sort of get those returns. The world has sort of changed a little bit in that we saw rates start to rise and inflation, etc., and the attraction of fixed income picked up. But more recently, it started to go a bit the other way again. We're sort of leveling out with yields coming down more recently. Are you sort of moving away from fixed income again and back to alternatives in the portfolio? Maybe just to talk us through what that looks like in practice.
Yes, so that has been the direction of travel, and I wouldn't say we're aggressively changing asset classes from one quarter to the next. It's more of a journey in which when the opportunities arise, we move in that direction. And that is the great thing about income investing. As many listeners will be aware, historically there was a great demand for equity income, just the philosophy of compounding income over the longer term and what it can do for long-term returns stacks up. And with multi-asset, it's a very similar story. We just have a wider array of asset classes or tools in the toolkit in which to achieve that. And so if there's a dearth of income in one asset class, we just won't be there. It's a great valuation tool, an indicator of where value is in markets. And so it kept us away from bonds when bond yields were very low. And as we went through 2022, obviously that was a great thing. And we had a larger allocation to alternatives. And so when most multi-asset funds were down double digit in 2022, we actually delivered a positive return because we only had, about 12% in bonds. And because inflation had picked up, obviously the demand for real assets increased. And so we had a very strong performance out of those real assets. As we went into 2023 and bond yields were at a higher level, becoming more attractive, we then reduced the alternatives in the portfolio, which had done very well, and moved into bonds. And as you've kind of highlighted over the last 18 months, actually there's not been a lot of demand for those real assets, and it's been a pretty torrid period. And so we took our allocation to alternatives in 2022 to 2023 down from about 35% into about 15-16%, and more recently we've been increasing that back up to the mid-20 sort of level, and bonds have come down from that 30% level down to about 20% as the opportunity set has changed. And effectively what we've done is bonds have been fairly reasonable. You had some income over the last 12 to 18 months. We had a bit of capital growth, and we've switched from what is about a 4% yield today in government bonds, and we're reallocating that into some of the real asset areas where we're getting 9-10% dividend yields. And that helps us obviously to grow the income for clients over the longer term as well.
Well, let's just be clear as well. I mean, that it's not just a case of running toward where the higher dividends are. I mean, there are sentiment issues because you're going through investment trusts here as well. I mean, you're getting double-digit discounts on some of those trusts as well from a sentiment perspective, on top of those attractive yields.
Yeah, I mean, there's a few things that have happened. Obviously, as bond yields have risen, the discount rates that are used for valuing these assets have gone up, which has put the net asset values under pressure. But on top of that, the negative sentiment that you've seen from investors means that you've gone from what was a premium to that net asset value to now, in some cases, 20% to 30% discounts to net asset value. And so we think it's been a pretty difficult time, but now one in which on a forward-looking basis, you're now getting paid for many of those risks that are inherent within those asset classes. And if inflation does pick up, if the oil price, energy prices remain more elevated, then perhaps, or corporates start to push through some of the costs of tariffs that we've seen rise over the last few years, that could put inflation under more pressure on the upside, and people and demand for real assets will start to increase again. But ultimately, we just think over a 3 to 5 year investment horizon, the relative opportunity set within the real asset space looks fairly attractive compared to other areas in which we can invest.
And maybe let's just go into a couple of those areas. The first one worth talking about is obviously property. You mentioned earlier how, if things don't look nice, you're quite happy to go away and leave them alone. Property is something you've brought back into the portfolio recently, isn't it?
Yes, so we've had quite a long period actually, where we've had very little, in some cases nothing, over periods of time in property, just because obviously there was a lot of risk around valuations with low interest rates, and as bond yields rose, that put real estate under quite a lot of pressure as well. More recently, we've been increasing our allocation to property, particularly in areas where we think there is more thematic trends towards those areas. So high quality office, particularly in areas like Australia, where we've brought in Dexus, and healthcare REITs where population dynamics with aging population supports demand for the services in that healthcare area, and then in some of the digital infrastructure areas, digital property, where they've been benefited from those strong thematic tailwinds as well. So properties now, it's gone from 0% in the fund to about 4% in the fund, and as we see the opportunities, we'll continue to add to those areas.
And another one, obviously, is sort of infrastructure or renewable infrastructure. Obviously, that's a long-term trend. Is that just a price? Is there a pricing attraction in that area specifically that you're finding at the moment?
Yeah, it's been, particularly in the UK, fairly challenged, just given some of the changes that we've seen from government intervention, which is one of the main risks, given they have fixed inflation-linked contracts. But the government's changed the inflation assumptions from RPI to CPI, and so the negative sentiment around that has really come through in the share prices. And obviously, as we went through the war in Ukraine, that led to very high power prices, and government looked to reduce some of the support, given the benefits they were having from those very high power prices, and they put in a taxation on some of the renewable generators, and so that was another hit to sentiment within the renewable space. But we do think that now with the discounts to NAV more than compensating for those risks, and seeing double-digit yields, that does provide good coverage for some of the risks that are inherent within that asset class.
Okay. One of the things I saw you mention was that within the equities bucket, you've sort of been looking to have more of a value income tilt. I think maybe it's good for the listeners just to sort of understand what that is and where you've sort of been targeting that specific area of the market, from what sort of angle you've been targeting that sort of area of the market.
Well, yeah, I mean, certainly that's what you will get with an income fund. Obviously, it's very challenging to get exposure to technology within an income strategy. And so we are significantly underweight technology against an MSCI benchmark weight. But we've also been taking profits in some of the beneficiaries of the build out of data centers, demand for AI in the United States, where we have seen very strong performance out of some of those companies, like Train Technologies, which makes HVAC equipment, or heating and ventilation, air conditioning equipment that goes into data centers. And they've seen, strong demand for their products. And we've been moving that to some of the beneficiaries in Europe, where we're about 2 to 3 years behind the build out of data centers compared to the United States. And so we're trying to find some of the companies that will benefit as that starts to play out in Europe.
And I think you mentioned you were looking a bit more at some of the industrials and the staples markets as well.
Yes, so within that will be the industrials. So companies that benefit from the build out of the infrastructure for the grid. Some of the companies that perhaps can use AI within their businesses to be able to improve efficiencies, increase their margins, and that should help them to deliver better earnings growth and therefore attract higher valuations. And so it's not just about the risks around AI and who are the losers and the winners of AI, but more importantly, I think as this broadens out, it will be about who utilises the technology to improve their business models. And we particularly think industrial companies will be able to use that. And then on the other side of that, clearly, staples have had a fairly torrid time as bond yields have risen. But it's probably one of the areas that are perhaps is less at risk of AI as people continue to have to feed themselves, clothe themselves. And so we see staples as an area of the market that is probably more resilient towards the risks around AI.
Okay. And I guess just lastly, obviously stock selection, we talked before, and you mentioned that stock selection is determined by 4 specific factors. And just quickly to run through them. So you've got the global themes, around everywhere, basically. Company fundamentals, which is the likes of balance sheets, the ESG footprint of a company, and also valuations. Now, we live in a market where things look across the board fairly expensive versus history in most parts of the world. Is that the area that's driving your attention more than any other at the moment? Maybe just talk us through how that balances out across those 4 specific factors.
Yeah, from a thematic standpoint, obviously Newton is a very thematic house. And to put that in perspective, it's not about finding themes and then picking securities that fit that theme and put them into a portfolio. It's much more about trying to direct our analysts and fund managers to really think about themes when we're picking securities and try to identify areas that will benefit from structural growth areas and perhaps avoid the areas that face significant headwinds. Obviously, those themes change over time, but they're really just big picture themes that are driving global change in society. And that comes into our work when we're doing the company fundamentals. From a balance sheet perspective, we think that's quite important, particularly given the higher cost of financing with higher interest rates that we think will be around in the next decade compared to what we've seen post the financial crisis period, but also because of the risks around AI and the challenge that companies will have to face. And so you want a strong balance sheet to be able to navigate that dynamic. ESG, for us, that is just part of due diligence, making sure we're covering off on the governance aspect, the environmental and social impact that can have an impact on a company's business model. It's not about in particular excluding things or having some kind of filter to avoid areas. It is certainly for us just part of the due diligence and making sure that those risks and opportunities are evaluated in the valuation work we do when assessing a company. I think more and more, given the high valuations we see, particularly in the United States, it's becoming apparent to us that we need to be more considerate of those risks with a higher interest rate environment, because the opportunity set, the ability to get a return from the bond market, for example, is an opportunity for investors. And so where we see dislocations across markets, particularly from a geographical standpoint, that provides opportunity to get similar exposures, perhaps at lower valuations. And particularly in these markets today, where valuations in the United States do look stretched across the market, there are opportunities in emerging markets and in Europe where we are seeing good opportunities for long-term returns. And so we've been doing a little bit more work in those areas and reallocating some of the capital into the portfolios at the margins into some of those opportunities.
Is it a case of just like, obviously you always want to maintain some sort of balance, but perhaps balance is as important as ever at the moment, given that where the value of US equities are in particular, there might be a bit more dispersion of returns from here?
Yeah, and certainly we're seeing that in the market, aren't we? I mean, software stocks used to be on very high multiples because of the high recurring revenue streams in a world where there's a lot of disruption, obviously from AI. We've seen over the last 6 months, some of those software names come more into the forefront. And it's just a question around how sustainable are those revenue streams and those business models. And so we believe it's good to have valuation discipline across the market, given the uncertainty that can be created by these tectonic shifts that we're seeing, both from a geopolitical standpoint, but also from a technological standpoint as well. And it's ever more prominent now, given the disruption factors that we're seeing.
Okay. Paul, on that note, thank you very much for joining us today.
Thank you very much for having us.
No problem at all.
The BNY Mellon Multi-Asset Income Fund seeks to achieve a stable income with the potential for capital growth over the long term by investing in equities, bonds, and alternatives. Since launching in 2015, the fund has been a consistently strong performer whilst maintaining an attractive yield. To learn more about the fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.